Hi, my name is Ed Rieu. I'm a partner with Blick Rothenberg's US-UK tax practice. I deal mainly with corporations, partnerships, and trusts with respect to high net worth individuals and entrepreneurs. Today we're going to talk about the family business in a divorce. I'm joined today by my partner Mark Levitt, who has quite a bit of experience dealing with family businesses in a divorce setting. Mark?
Like my colleague Ed, I'm a private client tax partner, but I also have been doing matrimonial work, acting as an expert witness for over 25 years and have appeared in court on many times.
One of the main assets in a financial settlement in a divorce of a married couple or in a civil partnership is the family business. And there's a lot of things we need to be thinking about when we sell the family business, transfer it, etc., particularly where it's been run by one side of the family for quite a long time. Mark, what are some of the issues that we need to be thinking about?
The issues are that you might have one member of the family involved in the business, but both of them actually have shares in the company.
Yeah.
And as you rightly say, Ed, it is probably it can be the most valuable asset in a marital relationship. So when you're thinking about a split, a separation, you have to work out how it's going to be funded, given that the company is always regarded as by the court as the golden goose.
So when you say funded, what do you mean?
What I mean is that in order to, for example, buy out one of the parties from that business, it may well be that the company doesn't have the wherewithal to do it in one go. And there are various different ways that this can be done.
Like what?
For example, the company could buy the shares, doing what's known as a purchase of own shares. There are conditions that are required. It has to be a trading company. The person has to be UK resident. They have to have held the shares for 5 years. But that can be very helpful. And if you do a purchase of own shares, it is possible in the right circumstances to do a staggered completion over a period of time, and you'd agree that with the tax authorities.
So the gain that arises from that purchase of own shares or from a sale of the company, what's the UK tax consequence to selling a company that's a trading enterprise?
So if it's a trading enterprise and you qualify for the business asset relief, the first £1 million is taxed at 10%. Anything above that is at 20%. Currently, Ed, we have very low relative capital gains tax rates. However, we don't know whether there might be a rate change in the future. Perhaps I can ask you the question, where one of the parties are US.
Yeah.
How would it be treated if the company's buying out a US person that owns shares in the company?
When a U.S. person sells a business, the capital gain is taxed in the U.S. at rates of 20%. There's no relief for that first million like you have, and that tax is at 20% plus a 3.8% net investment income tax. That tax can be offset with UK taxes on a foreign tax credit basis if they qualify.
So what you're saying is that actually the US rate of 20%, which is the same as the 20%, they should be, despite the fact they don't get the 10%, they should be no worse off apart from the 3.8%.
Provided they have the right foreign tax credit mix. How do you determine what a company's worth in a private setting?
So we have the skills within Blick Rothenberg to carry out company valuations.
Right.
And depending on the type of company, whether it's a trading company or whether it's an investment company, will determine what type of valuation. It may well be the classical way is you do it on a multiple of profits, and then you apply a multiplier. I mean, no two valuers are going to end up with the same value. If, for example, it's a property company, which is going to be assets, then you'd have the assets revalued.
Right. So
does that have any consequences how we value from a US?
It could, because the valuations normally, I mean, if you could have discounts and other factors that can come in, and the U.S. will look at it in a different way as to whether or not discounts should be applied, as a for example, and your methodology in respect of whether you use enterprise value, present cash flow value, using Black-Scholes or some other model, the U.S. IRS is free to challenge if it's not done pursuant to prescribed U.S. methods. But normally, I would have thought couples don't want to double up on valuation expense. So there was one point I also wanted to make, which was from a non-UK company perspective, if the couple own a US company, it may be possible that if that US company was set up in a certain way, owned by an American, the gain on that would be exempt from a US perspective for US tax purposes. Again, I go back to asking one other question to you. Is it possible to get business asset disposal relief for partnership interests and for interests in non-UK companies?
So for a partnership, if it's a trading partnership, that can qualify for business asset disposal relief,
Right.
the lower capital gains tax
Right.
rate. For foreign incorporated companies, the same applies, but it has to be a trading company.
Right.
So that's quite key.
Yeah.
A trading company will have the benefit of the business asset disposal relief.
So I think we can see through this that there's a lot of complication, a lot of complexity in respect of disposal of a family business, and a lot of things need to be thought about. We trust you found this useful, and if you want to follow up with further questions to any of the BR team, please feel free to contact us through the website.